Okay, welcome back. Lesson 3. We are going to get into the nuts and bolts of investment analysis. So sit down, get ready, take some notes. This is going to be a big lesson. We're going to be dealing with all aspects of investment analysis. Effectively, I am portraying and taking 25 years of my career, my commercial appraisal background, commercial real estate sales knowledge, and we're packing it into about an hour and a half. So take notes, feel free to stop the video along the way and replay things because we're going to come fast and furious with a lot of things. So let's jump right into lesson 3, investment analysis. And again, where we've been, we have talked about where CRE, what is CRE, why commercial real estate, who are some of the players involved. We've talked about leasing versus sales, and now we're at the investment analysis section. So let's hop in. Let's talk a little bit about what we're going to be going through in this lesson. One of the key pieces, the number that we're trying to derive, the number that you are trying to come up with or convey to your buyers, your sellers, is NOI, net operating income. And this is really the holy grail, if you will, of what we're trying to get to, what we're going to be analyzing. It is the number that we're going to be dividing by a cap rate to come up with value or extrapolating from comparables to get a cap rate, and we're going to talk about all that. So the importance of NOI is that it is first and foremost the most important number that when we're analyzing a property. The benefits of owning investment real estate, we're going to talk about that. Why do people do that? There's 4 main benefits of owning investment real estate. We're going to go through that. We're going to talk about income, expense, valuations. We're going to talk about how to calculate value. We're going to look at what a cap rate is and what it's not. We're going to talk about net present value, talk about cash flow models, how to analyze a property over multiple years and how we do that. And we've got some tools and some templates for you that are going to automatically do that. In that cash flow model, we're going to generate an internal rate of return, IRR. And you'll be able to do that at the end of this session. And then we'll round it out with just talking about capital accumulation and why, again, principal reduction, capital appreciation, all very, very important aspects of why people buy and hold real estate as an investment. So let's hop in. Let's talk about the importance of NOI. Net operating income. Is a calculation used to analyze real estate investments that generate income. NOI really is essentially if we take all of the income, all of the potential income, and we subtract out a vacancy and we then take off any expenses that we have to the property, we get net operating income. And this is before tax. This is before we have a mortgage payment, before principal and interest is taken out. So it is the number that we then can use to either enjoy those benefits of, pay tax on, make our mortgage payment on. So it's the bottom line number. Typically, we do not include in our expenses to derive NOI large major capital expenditures. We talked about in the last lesson about large CapEx expenditures like roof, parking lot restriping, big events that might only happen once every 5, 10, 20 years. Those we try to pull out below the line. So that would not be an expense that then derives NOI. So we just want to make sure that that's correct. And we've got a little graph here that will explain exactly, PGI, potential gross income, minus your vacancy, plus any additional income. And some properties do have additional income that's different than maybe your normal standard tenants that pay. Minus expenses equals NOI. You've got to know this formula inside and out. You're going to live and die by this formula as a commercial broker, as an investor. So again, this is the formula, potential gross income, PGI. I want to drive this home, minus vacancy and credit loss. A lot of times we'll say in the in the market that there's no vacancy or there's very, very low vacancy. As in today in my market, multifamily apartment buildings have a very low vacancy rate. Maybe it's less than 1%. Although we tend to lose revenue from bad credit with tenants. And so we also have to take off a little extra percentage, typically another 0.5% to 1% for credit loss. And so this is something that I believe you need to make sure that you're accounting for when you're looking at your properties, and not underestimate a very low vacancy rate, which then can impact value. And we'll show you how that impacts on the spreadsheet later. This equals our effective gross income, our EGI. So the EGI should be the number that the owners are basically collecting after they have any stabilized vacancy rates. And so that number, really, we would then take and add in any additional income. Additional income could be parking revenue. In an apartment building, it might be laundry income. If there's not washers and dryers in the units, maybe there's a laundry facility, parking income, additional non-refundable security deposits, pet deposits. Could be a variety of different things. Sometimes in commercial properties, you might see that there might be maybe a cell tower or some other income that maybe isn't regular, or a percentage rent income that comes in from a certain tenant. And we'll talk about some of those other additional income. But for the most part, that's going to be a pretty minor part of the equation. PGI, those rents that are coming in from the tenants, should account for a majority, if not all, of your income. That gets us again to our EGI, our effective gross income, and then we're going to take off those expenses. And depending on the lease structure, which we've talked about in a previous lesson, if the leases are triple net, then the tenants are paying for most of those expenses. So the expenses are going to be pretty low or very nominal. In an apartment situation where the owner is paying for taxes and insurance and repairs and maintenance, move-in, move-outs, any other legal fees that they might have, property management fees, those are all going to come out of the expense ratio. And once we've taken that out, we then get to our NOI. And we're going to talk about this in our Knox Street template, which you have access to in your course. And we'll go through that spreadsheet actually live here in a little bit. So this NOI really is again, that number that we strive for, that we try to look at, and we analyze other properties based on our subject property. We look at other comparables. What was their NOI? We can look at that on a per square foot basis. We can divide that into a per unit basis. How many units do we have in the apartment building? How many square feet do we have in the office building, the retail building? We can divide that and look at other properties and see how they're doing on an NOI per square foot basis. And that's one way to compare those properties and look and say, hey, my property is doing much better than others on an NOI basis. Or, man, I'm a little bit lower than some of the comparables that have sold here in the market. And that's another way you can compare NOI to other properties. That said, we have taken a little step back here. We have 4 main benefits of owning investment real estate, and they are cash flow, principal reduction, taxes, a lot of tax benefits, especially with the new tax law here in 2018 that was just enacted, and then appreciation. And so these 4 benefits are why investors buy and sell commercial real estate and investment real estate. And so let's start talking about those, and let's go through those, and we'll bring in our Knox Street example and show you what some of those numbers actually are. Cash flow. This has got to be the number one reason. We take a dollar amount, we put down on the property, and then we enjoy those benefits that are coming in. We have a definition here of what cash flow is. The annual cash flow before tax for real estate investment properties are typically broken out line by line on the real estate pro forma. And we're going to take you to the Knox Street pro forma and show you that here in a little bit. So again, the net result is the gross income, that potential gross income minus expenses. And then in cash flow, we are going to go ahead and take out the debt service. So we've got a mortgage, assuming we have debt or a mortgage on it. And that is the net cash flow to the property. So when we look at the Knox Street example, and again, here we have Knox Street, and you're going to see this on your spreadsheet. This particular investor, the property sold for $4 million. The investor put $1.2 million down, and they had a mortgage for $2.8 million. And so the cash on cash return on that $1.2 million that they put down is 4.2%. When you take into account the principal reduction that they have, and this is on an annual basis, the number actually increases to 8.3%. The expense ratio, how much the total expenses were on the property, is just under 25%. And then the cap rate, which is the NOI, the net operating income, divided into the purchase price, which was $4 million, is 5.3%. So if the owner paid cash for the property, if they put all $4 million down and didn't have a mortgage, their return would be 5.3%. But because they put money down and they got a loan and they're enjoying those benefits, their cash on cash return is actually a little bit less. It's 4.2%. And we're going to talk about why that is. And we're going to look at that on the spreadsheet here. Well, let's go ahead and go there right now. Let's bring up the spreadsheet, the Knox spreadsheet. And if you're just bringing this up for the first time, you'll see this is my template that I've created over years and edited. And what we have done here is we have built out the income to the property. So we have 18 total units, as you can see here at the bottom. The total amount of bedrooms is 39. I've calculated that out. And each unit is broken out here. We've got 2 studios. We've got a variety of 1 bedroom or 2 bedrooms and 3 bedrooms. I have each unit number broken out here, the square footage, what the market rent is. I've then analyzed the rent per square foot. That's calculating it. We're looking at the monthly income and then the annual income. And then we have here a vacancy and a credit loss of, I'm using 3% in my market. And once we deduct that, we get an effective gross income of just under $278,000. So there's that number. As we scroll down, we do have some additional supplemental income. We've got some parking income and and a little bit of storage income. There's a couple storage units on this that were rented out on a month in, month out basis. And so that total effective gross income is $279,603, as you'll see. And then we go ahead and after we get our effective gross income, we then have taken out all of our expenses. And so I have these broken out in a way that I like them broken out, and I looked at fixed expenses, which are your real estate taxes. In our market, we have rental licensing fees and insurance. Those are just must-haves. We have utilities, and in this case, we've normalized the utilities. I've looked at this property and I've looked at the income and expenses for 3 years, and so I've kind of averaged them out over the 3 years, looked at where the current market is and where rates are for utilities, and this was basically our best number, or in some cases it was the actual number for the current year or the previous year. And so our total utilities is around $10,000. We then have maintenance and repairs, and this is going to be your supplies, your maintenance, your unit turnover. If there's a fire system, if you've got a sprinkler system, you have annual maintenance. This is all going to be included in that. Pest control, landscaping, kind of lump all those into this category, and we have a total dollar amount, as you can see there, of just over $11,000. Property management, and you might find in your market that people are self-managing. When we're valuing a property, we still want to make sure that we take a management fee out. So this particular property was being managed for 5%, and that 5% number is essentially calculating, this number is going and grabbing 5% from the EGI line in the spreadsheet and bringing it back it's just under $14,000 per year. Some properties, and I leave this category in here because a larger property might have on-site payroll where you have a maintenance person that's maybe part-time, or you've given somebody a rent concession to be able to watch over the property, or you have a full-time on-site manager. This is an area that you would put all that information in. This is an 18-unit apartment building that doesn't require any on-site administrative or employees, and so we don't have any numbers there. Advertising, the nominal $100 in here. In this particular case, this property is being managed and the property management company does all the advertising, but we threw in $100 there for some very nominal advertising that was done. Our market is very strong and doesn't take a lot of advertising to be able to bring in tenants to this property. I also have an area here for office administration, miscellaneous, and we talk about, and I've got legal and audit if in this particular case the owner has an LLC and they have annual fees due for their company, and then occasionally there's a tenant that maybe has some bad debt or something that needs to be done, or an attorney needs to be advised. You want to make sure that you're pulling out something for that. We have some numbers coming out for security as well. And then we get down at the very bottom the total expenses, which are just shy of $69,000, which again, the expense ratio of 24.6% is calculated based on the $69,000 divided into the EGI. So total expenses divided by the EGI number is going to give us that ratio, that expense ratio. And you can look at other properties and in the market that have sold and look at their expense ratios. What are they selling for? Are they selling at 20%? Are they selling at 40%? Where is the market? So we know in our market that we're seeing properties on the low end from 22, 23% to as high as 35%. This is a newer property and it's running fairly efficiently. There's not a lot of repairs and maintenance needed, and so 25% was, I would say, at the low end of the range, but still reasonable. And so we went ahead and utilized that number. And then as we get to the very bottom here, you're going to see a grid. We've got a capitalization grid, and you can select these numbers to whatever you'd like. I have my grid based on where the market currently is, from 4 3/4 cap up to 5 3/4 cap, and this shows you the impact of value. And what we have done here is we know that the property sold for $4 million, and so that cap rate is 5.3%. And then we get our indicators and such. And so as we go back to the main slide, you're going to see that we've got some of these summary, these different calculations are all coming from that spreadsheet. And so we're pulling that information out. I didn't show you the internal rate of return, and we're going to get to that a little later in this session. And we'll talk to you about how to look at that investment over a long period of time. But from the first benefit of enjoying cash flow, again, the cash on cash return, 4.2%, which is the return that they're getting based on the $1.2 million that they invested and the cash flow that they're getting back out after they pay their mortgage. So as we move on to the second benefit of owning real estate is principal reduction. When you get a mortgage, every month there is principal and interest that's being paid on that mortgage. And so a certain percentage of that loan, depending on the rate and the amortization period, is going towards reducing the principal. And investors buy commercial real estate, investment real estate, for that benefit alone, to reduce that principal over time. And we're going to show you how that works back in the spreadsheet. And if we go back to our spreadsheet again, we're going to show you here that down at the very bottom of the spreadsheet where we were, you're going to see the loan details here. So you can see that we've got a $1.2 million, which was put down, which is 30% of the purchase price. The loan is $2.8 million, which is a 70% loan to value, or LTV. And then the interest rate at the time was 4% over 30 years. And so this actually calculates, if we scroll down just a little bit more here, you're going to see the monthly payments of just over $13,000 a month, and then the annual debt service of $160,000. So when we take our NOI, which is if we scroll back up, you'll see our NOI. You're going to see that we've got our NOI a little bit further here. We got $210,000 roughly of NOI minus our if we scroll back down here to see the payments, $160,000. That gets us $50,000 of annual cash flow. And everything that we're doing is on an annual basis. So when we divide $50,000, 425, into the 1.2 million, that equates to the 4.2% return on the investment. And that's it. That's the math to get cash on cash return. So going back to that second principle of principal reduction, in this mortgage payment of $160,000 a year or $13,000 a month is going to be a portion of interest and a portion of principal. And we're going to see that on the second tab. So down at the bottom, you've got 4 tabs. You've got the 2011 Knox tab, which is going to be the main worksheet that you'll be able to see the Knox transaction and edit your own investment properties. The second tab is going to be the 10-year cash flow. And we're jumping ahead a little bit here, but we've got a calculation every year of the cumulative principal reduction. So this spreadsheet goes out for you and estimates to the penny what the principal reduction is. So in the first year, you're going to see that there was $49,309 of principal reduction reduced on that mortgage. So if the property doesn't go up in value, if it doesn't go down in value, if it stays the exact same at $4 million, at the end of 1 year, we've enjoyed the benefits of 4.2% on this investment, or roughly $50,425. Plus, we've had principal reduction of $49,000. So for a total of almost $100,000 that we've made on that investment, or 8.31%. So when you see that 8.31% of cash on cash return with principal reduction, that's how we derive that number. And that's really key and crucial to be able to show a potential investor that they're making money on principal reduction, the second benefit of owning real estate. And principal reduction is very powerful. You can see here that every year that number increases because the loan amortization schedule, the amount of interest that you pay, slowly declines over the amortization period. This is a 30-year amortization at 4%, and there is an actual schedule. And if you click on, we won't go there, but if you click on the loan amortization table, we'll go ahead and click there and show you briefly. Behind the scenes, go ahead and click there, and we will actually show you the loan amortization for the entire property. So this shows you the scheduled interest and principal for every month. And you can see that the interest portion is dropping and that the principal portion is increasing all the way up till we get to 30 years, 360 months in this. And as you change this, if you go back and you change it to 25 years or 20 years or 30 years or whatever you want, it will automatically calculate your principal and interest and all the numbers for you. So very, very powerful. Principal reduction is, again, our number 2 benefit to owning investment real estate. So as we head back to our main slides here, again, we're going to see here that we've got the numbers here. We viewed the spreadsheet, and we know exactly what the principal reduction is. So we'll move on to the next benefit, which is the third benefit, which is taxes. So again, 4 main benefits of owning commercial real estate: investment property, cash flow, principal reduction, and taxes. Taxes can be very, very beneficial to owning investment real estate. And the main way this is done is through depreciation. And depending on the property type that you have, whether it's commercial or residential, it's going to be classified a certain way. And you'll see here that depreciation, again, reduces the owner's tax bill or the amount of taxes that they pay by basically looking at the useful life of the building. And this is an IRS code that allows you to do this. And we depreciate commercial structures over 39 years. That's a commercial structure. Now, in the case of Knox Street, we're going to get the residential depreciation amount, which is 27 and a half years. So again, a little bit faster on a straight line depreciation. There are several different ways that you can depreciate your real estate investment asset. This is the most common, the straight line depreciation method. There are other more aggressive ways of depreciating your investment real estate, and that will accelerate that. And you need to talk to your tax advisor. We're actually going to take you to my tax advisor, and he's going to talk about some of those a little bit later in this session. But one method that you're going to want to look into or advise your clients to at least consider will be the cost segregation method. And this is a third-party report that will come in, analyze your investment property, and allow you to write off substantially more of your asset in the first year, early years of buying that property or putting that property into place. And so this is something that you'll want to look into. It's a strategy I've used personally and have advised other clients to look at and consider with their advisors. So, but for now, straight line depreciation, 39 years for commercial, 27 and a half for residential, and this is really the third major benefit of owning commercial real estate. We're going to go ahead and take you to another tab, which is the 4 benefits of owning investment real estate. So you have 2 tabs in your resource center. One is the Knox spreadsheet, which is the main Knox spreadsheet we just went through, and the other is the 4 benefits tab. And this is essentially a very similar tab to what we currently did, but this breaks down based on the percentage of land to building, and it actually looks at the land cost that we've estimated, how much personal property is in the investment, the building cost, and then the land cost, and then we're depreciating those at different amounts. As you can see, 3.64% is that 1 year into 27 and a half years. That's the math. That's the amount percentage we can deduct in 1 year with a straight line depreciation. And we're depreciating personal property at 20%, and we're depreciating the land at 5%. So each one has their own ratio. And again, you need to consult your tax advisor. And at the time of the shooting, this is where those numbers were. And so they are subject to change and subject to whatever tax strategies you might be using. So this is calculating, though, the total amount of depreciation that this investor can take in the first year, which is roughly $142,000. So this worksheet is here for you. This is the worksheet that was used on Knox Street. And as you scroll down, it does a very quick and easy income and expense analysis. And then we actually go through the 4 benefits of owning: cash flow, principal reduction, income tax paid or saved, and then we talk about appreciation, which is the next and the 4th and final benefit of owning investment real estate. So when we go back to our main tab here, and we'll head to slide 14, I believe, and we'll talk about appreciation. And this can be one of the most powerful benefits to owning investment real estate, is that as investments rise or fall, we obviously enjoy those benefits. On average, property values have increased over close to a 100-year time period of just over 4% per year. Clearly, we had a major decline in 2008 and 2009 during the Great Recession, and property values dropped. Although investment properties like apartment buildings, some rose. Investment properties have a different, I would say, mechanism, if you will, on appreciation. And a lot of that varies directly on the income, as we've talked about. That NOI number. as NOI increases or decreases, that value is going to increase or decrease as well. One key note here is that as cap rates, which we're going to talk about in a little bit here, but that's the rate of return that you get in 1 year if you paid cash for the property. And in the Knox Street example, it was 5.3%. So if we paid cash for a $4 million asset, 5.3% was going to give us that amount of money in 1 year without any loan on it. So 5.3%. As interest rates increase, there is a direct correlation to interest rates and cap rates. So since 2008 to 2018, over a 10-year time period, we have for the most part seen the 10-year treasury rates, medium, small, short, medium, and long-term interest rates decline over that time period. And as they've declined, the cap rates have also declined. We call it cap rate compression or a reduction in cap rates. Cap rates for this market, for Knox Street, would have been somewhere in the 8% range 10 years ago. When this property sold, it was 5.3%. And so that was a variety, that was one way that the property appreciated over that time span, was through a reduction in the cap rate. The amount of return needed in order to purchase the property. And so as those returns have come down, investors are willing to pay larger prices for those assets. If we are in a rising rate environment, that rate has to increase, and thus the property values are going to have a more difficult time in increasing in value. So that's just something to be considering as we look at that fourth benefit, which is appreciation for commercial real estate. So again, appreciation, you have to check your market. Every market is different, and you need to also factor in, as interest rates rise, cap rates will have some headwinds, will also potentially increase as well. So it depends on your market, depends on the asset type, depends on the credit worthiness of the tenants that have signed the leases as to what someone will pay for an investment, what cap rate they will charge. This next slide is just a grid of real estate appreciation rates over the past 5 and 10 years. And since 1975, it kind of gives you some numbers. So click on that link and feel free to check that out. A lot of this data is more residential oriented, so it's not as applicable for, say, a commercial investment or a multifamily apartment building. But we threw this in here for you just so you can have a good idea, depending on where you're at, what those appreciation rates might have been. So we're going to take you now back to the spreadsheet tab, the Knox spreadsheet. And we're gonna show you back on the 10-year tab. So we're here, and again, just to refamiliar ourselves, there's 4 tabs at the bottom. Knox Street, 2011 Knox Street is the main potential gross income, effective gross income, expense ratios, and the valuation of the property. The next tab, the 10-year tab, is looking at the investment over 10 years. And you saw down, if we scroll down to the bottom, you're going to see a number that's the IRR, or the internal rate of return. And that number is just over 15%. And what this number means is effectively it is the rate that you would achieve over a certain time period every year, assuming you buy the property, enjoy the benefits of real estate, and then sell the investment. So there's a lot of assumptions that go into this number. And so, but it's a great example of showing how appreciation in rents can increase or decrease the value. So as we scroll back up to the top, and you're gonna see over here on the very far right side an income ratio and an expense ratio. So we are assuming in this 10-year cash flow model that incomes, the residential rents, the apartment rents, are going up by 4%. We're also growing the expenses at 3%. So if we were to change this number from 4% to 5%, you're then going to see that now year 2 went from 290 to 293,000. If we change the expenses to 4%, the expenses are going to go from 70,000 up to 71. So they're going to increase a little bit. If we scroll down to the very bottom, you're actually going to see the IRR actually went up by almost 2 percentage points, because expenses have grown. Even though expenses have grown at 1%, income's growing at a little larger percentage as well. And our total return and the valuation when we sell that property after 10 years has gone up dramatically. So taking into account all 4 benefits of commercial real estate, of owning investment real estate: cash flow, taxes, principal reduction, and then appreciation. This 10-year cash flow analysis essentially takes all of those into account. And you can kind of play with this a little bit based on where you where those numbers might be. One key thing, and again, we're jumping ahead a little bit, but you're going to see this valuation year 11 value, and that's a cap rate. And so we call this a reversionary cap rate, or the cap rate that the property will sell at in the future, in 10 years. So we're enjoying the benefits of this, of Knox Street apartment over 10 years. We're then going to sell it. Typically, we increase the cap rate about 0.5 percentage point higher than when we bought it. So we bought this at a 5.3% cap, and we then put in the reversionary cap rate at 6%, which is about 70 basis points higher, or 0.7% higher. If we were to put this number at 6.5%, you're going to then quickly see that the value goes from 5.9 million to 5.4, and our internal rate of return has dropped in this scenario. So again, depending on what we sell the property at and what that value is in 10 years is going to drastically impact the investor's return and their internal rate of return over that 10 years. Extremely powerful here, extremely powerful, and I want you to play with this. I want you to take some of your own examples, put them into this spreadsheet, play around and really understand that. As you do this on multiple properties, you're really going to understand all 4 benefits of investment real estate. You're going to be able to see the power of increased income, increased expenses, and how it impacts the valuation and the internal rate of return. So as we go back now to our main slide, we're going to talk a little bit about understanding value. We're going to come back a bit. We did a big broad overview of income, expenses, the 4 benefits of owning investment real estate, and then also how to look at the 10-year cash flow analysis and the internal rate of return. There's a lot there. You might need to stop right now, rewind, go back, revisit, take some time, open the spreadsheets, put in your own analysis, change those numbers so you truly understand what's happening and what's going on, because I think that will looking at examples, specific examples in your market, will help you learn and understand this process. And the more properties you analyze and value and put through these tests, the easier this is going to become. I have analyzed hundreds and hundreds of properties, and we just enjoy doing it. It becomes second nature. This can become second nature for you, but you need to put in some of those properties, look at other deals that have been done in the market, analyze them in this spreadsheet. This is the core issue. This is going to be the way that you can take your business to the next level, is by looking at multiple different deals, learning from the deals that I've done, putting other properties into this formula and seeing the power of them. And you'll be able to then spot a good deal or a bad deal by looking at multiple properties. And so it'll become very, very evident. So I want you to spend some time in doing this. Okay, understanding value. We talked about NOI. We talked about income minus the expenses. That gets us our NOI. When we take those numbers and we divide that into the cap rate, we get the value. And so If we go to the next slide, yeah, we're going to see NOI on the top. That's the total dollar amounts that we brought in after we pay all of our expenses. We bring in that income. We have a little vacancy. We take off the expenses. We get our NOI. NOI is before principal reduction, before interest, before our mortgage payment, before taxes. And so we take that dollar amount and we then divide it into a cap rate. So when we take the dollar amounts, when we go back to our Knox Street tab, we go back to our spreadsheet here, and we'll do that now, Knox spreadsheet, and we go to the very first tab, the 2011 Knox Street tab, and down at if we scroll down just a little bit here, scroll up a little bit, sorry, we're gonna see this grid here. So you see the capitalization rates, at 5.25%, the value is $400,000. If we scroll up a little bit more, you're going to see the NOI, which is $210,000. So that number divided into 5.25 gets us a little over $4 million. If we only needed a 5% return on our investment for that $210,000, we can actually pay $4.2 million for the property. If we require a 5.75% cap rate, we can only pay $3.66 million for the property. So as you can see, as cap rates go down, values increase. As cap rates move up, values decrease. There's an inverse relationship to the cap rate and NOI. In this scenario, the NOI is what it is. It's $210,000. The rents are coming in. We know what the expenses are. Those are relatively fixed. We might be able to increase rents maybe in 6 months or a year. We can run a projection that looks at that as well. But for the most part, that NOI number is what it is. So as we change the cap rates, we have a value here from anywhere from 4.4 million to 3.6 million. That's an $800,000 swing in value, based on really 1 full percentage point of cap rate return. So you need to understand that value and what your investors might require. If we required, let's just say, an 8% cap, if we change that 5.75 to 8 right now, we can only pay $2.6 million for that property. So as cap rates increase, as interest rates increase, and if we got back to a point where cap rates were 8%, that property has lost a substantial amount of its value. And so this is, again, buyer beware. You need to fully understand the power and the impact of a cap rate and what it can do to the value. Now, if interest rates are increasing at a dramatic rate, we're starting to see the Fed continue to short and long-term interest rates increase them. Hypothetically, we're seeing some inflation. If we're seeing inflation, we might be seeing rents increase at a dramatic rate as well. And so rents might be helping offset some of that value. So ideally, maybe our NOI is substantially higher as well as those cap rates increase. But that said, today in this market, this is where our market is, and you'll have to analyze where NOI is on your property, where cap rates are in your market. Side note here. How do I get a cap rate? Where do I derive that from? One way to be able to do that is going to be to go to other properties that have sold. And so how, this is going to be on your quiz here shortly, how are you going to derive a cap rate? Well, what do? We take the NOI of the property that's sold. We look at the NOI for the past 12 months or the projected NOI that the buyer is anticipating, and then we divide that into the purchase price and we get a cap rate. So if when you do that to 3 other similar properties and you get cap rates that are at, let's say, 6.5% or 7%, that's the ratio, again, if you will. That's the ratio, the cap rate of the income to the NOI to the purchase price. And the property that you're analyzing is at a 5.3% cap, like Knox, then this property might be priced well above the market because cap rates are higher than what you're analyzing the property at. So extracting cap rates from the market, looking at what other properties have sold, other apartment buildings in this case. And we're going to have some examples, some comps here in a little bit, and I'll take you through that. So I just really wanted to spend some time having you really analyze NOI, cap rate, and value. All three can be utilized to come up with one or the other. If you have the NOI and the cap rate, you can get the value. If you've got the value and the NOI, you can get the cap rate. If you've got the cap rate and the value, you can extrapolate the NOI. So they're all three directly correlated, and you can pick and choose which one you want to extrapolate if you have two of the three. So make sure you fully understand that. This next tab, again, I want you to try to go ahead and calculate out, at a 5 cap, what was Knox Street selling at a 6 cap, what would it sell at, and then the same for our Queen Street industrial sale. And so you've got the Queen Street tab, the spreadsheet as well in your resource tab. You can pull up and look at what that property sold at, and you can do this. I'd like you to do this 5, 10, 20 times. Find multiple properties, look at what those properties would sell at, what's the NOI, what did they sell at, what's the cap rate, or look at the market cap rates, try to understand where you think the cap rates might be for that asset type. Go and analyze a property NOI and come up with the value. And you might find that the property is priced well above the market, or maybe it's a screaming deal. Maybe it's priced way below. Maybe the owner has missed something. So again, understand this correlation. This is the foundation of investment real estate, is understanding these three dollar amounts. So these three indicators: NOI, cap rate, and value. Okay. We've done an overview now of investment real estate. That's probably about 18, 19 years of my life in maybe about 30 minutes. So again, you might need to stop, revisit this, play around in the spreadsheets, analyze other comparables, other sales, and rewind this video and watch it again. I think that would be very, very important. Feel free to email us, contact us, ask additional questions, and we're here as a resource for you. I want to take a step back now and really look at, as we've now kind of looked overall at the 4 benefits of real estate. We've looked at Knox Street a few different times, a few different ways. You've got the 2 different spreadsheets that analyze the Knox Street apartment building. And I want to take some time to really look at potential gross income. So we're going to go back and again, before we go back to the spreadsheet, I just want to make sure we've defined potential gross income, PGI. PGI is the amount of income that could be produced on the property if it's fully occupied. So a lot of people will look at a property or analyze a retail building, and it's got 2 tenants and it's half vacant. Well, what do I put in? Well, do I just put in one of the 2 tenants? Well, no. PGI is the potential gross income. What could it be rented for if I'm fully occupied? That's how we look and we value the property, is we assume that it's fully occupied. Now we have to then take out a vacancy rate or a collection loss. So if the vacancy rate is 50% in the market, well, then we're going to take off 50% in that line item. In the Knox Street template, we had the property fully occupied and we took off 3%. So you have to take off what's called a stabilized vacancy and credit loss for your market. And this might be doing an area market survey. This might be looking at other properties. What is the vacancy rate? It might be relying on third-party reports. There are a variety of providers out there that look at what vacancy rates are, and we've got some of those coming up in a little bit, and we'll talk to you about some of those resources. But as we go through, effective gross income is really the income produced by a piece of property with any additional income less that vacancy and collection loss, so EGI. So back to the Knox Street template, if you've got it open or you remember it, we've got the potential gross income of all the units fully occupied. We deducted out 3% for vacancy and credit loss. We added in a little bit of that additional parking revenue and that storage revenue, And then we got our total EGI. That's our effective gross income. And that should match up with what the owner is actually taking home every day or bringing into the account before they pay their expenses. So PGI minus the vacancy minus any credit loss equals the EGI. Want to make sure that we're looking at this. This is a great way of being able to analyze and analyze the property, look at the income to the property, how much it's generating as compared to other properties. So this, I want to take a minute here to define a couple of different versions of income. And so when we are looking at the Knox Street apartment building, and if those rents in the potential gross income line item, the studio, the 2 bedrooms, the 3 bedrooms, we feel are all at market. We feel that the market would support those rents of $800 a month, $1,100, $1,800 a month, whatever those rents are. That would be considered a fee simple value because those rents are at the market. They're similar to what the market would bear. In the example of the rents being, let's just say, way above market, let's say that those rents were $2,000 a month or $3,000 a month, and for some odd reason the rents are just much higher than any other comparable. We would consider that value to be a leased fee value. So it's not fee simple, it's leased fee. And a leased fee value is the ownership interest that the landlord or the lessor maintains in a property under the lease, which with the rights and the use and occupancy being conveyed to the tenant and the lessee. So it's subject to the lease agreement. And we see this not a lot of times in multifamily, but we'll see it in office transactions, in retail transactions, where a tenant maybe has an under market lease. They've let's take, for example, a retail building where the tenants had a long-term lease and the market is $20 a square foot on an annual basis. And they're currently leasing 1,000 square feet and they've got a 10-year lease. And the market's $20. If we were to have that space today, we could lease it for $20 a square foot per year. But the tenant is paying only $10 a square foot, and they have, let's just say, 6 or 7 years left on their lease, paying $1,000 a month. Their lease is below market. They have a leased fee value. You can't just put that dollar amount in to our spreadsheet as potential gross income at the market because they have multiple years left on that lease term. So that's where we have to start looking at the 10-year cash flow analysis, and we have to start playing with those numbers and saying, hey, we've got a tenant that's got maybe 3 years left, 5 years left, 6 years left at this below market rent, and then we have to then increase the value at that certain time to where the market would be. So fee simple value, leased fee value, essentially think of that as fee simple value, the rents that are currently being achieved at the property are at market. Leased fee value is that it's drastically above or below and the tenant has a long-term lease commitment, and I would say longer than 1 year would be my general indication. If that lease is below market and it's only for a year, we would probably go ahead and just adjust that value to where the market would be. So again, just something to be aware of, fee simple versus leased fee value. Just want to make sure that you fully understand that. We have a third lease value as well, which is called a leasehold value. And this is, again, where typically a good example of this might be where a tenant is leasing land. We have a tenant that leases a chunk of land and built their own building on it. And so they have a leasehold value. A lot of times a commercial tenant that is occupying a commercial space, and they have what would be considered a leasehold value on those improvements that they built out and put into the space. So again, there's a definition here. You can click on this and gather more information. Don't want to overwhelm you too much. with all of these value definitions, but I want you to be aware that there are different valuation indicators, different definitions of value, depending on the income and where it's at based on market to where the property is currently achieving. So keep that in mind. So as we define potential gross income, we look at whether it's leasehold value, leased fee value, or fee simple value. Most of the time, I would make an assumption that you're going to be dealing with a fee simple value, that those rents are at market. We're then going to take in that additional income. And as we talked about this before, this is going to be income that's outside of base rent. So those apartments in Knox are base rent. Parking income, additional income. Storage units down the hall, additional income. Again, a variety of different ways that you could have additional income. So just want you to be aware of that and make sure that you're breaking those out in your valuations and that you're identifying what those are. Vacancy and occupancy rates, our next tab. Again, we're talking about the vacancy rate, the stabilized vacancy rate. And this is, again, taking a number, a percentage, and in Knox Street, we use 3%. Your market might be 10%, might be 5%. 5% is a number that we've arbitrarily used for many, many years. That is kind of a number that we have used for time and time again. I don't know why that is, but it's you want to look at your market and determine where the current vacancies are. You can do a survey. You can do a study of 3 or 4 apartment buildings and find out where their occupancies currently are, where their vacancy rate is. High vacancy rate, obviously the property's not renting well. Low vacancy rate tends to be a strong rental market. Sometimes we see markets that have very low vacancy rates, but rents aren't increasing. You want to have some turnover in your properties, especially your multifamily properties, because you do want to see rents get to a certain level where you have a little bit of vacancy. If someone has had 0% vacancy for 10 years, I can make the assumption that they have not been raising rents, I would say, enough over that 10-year time period. You need to have some vacancy rate to be able to know that you're pushing those rents to where the market is. So again, general assumption there, but I want you to make sure you take that into consideration. Here's just a quick way of coming up with the vacancy and the occupancy rates. We just take the total rooms occupied, total units occupied, divided by the total rooms available, times 100 gets us the occupancy rate. It's a percentage, should be fairly easy, but here's the math. You can click on the link if you want to be able to figure out more information on how to calculate that. So again, stabilized vacancy is essentially the market vacancy, is the rate of available units. It is the vacancy rate that exists in the market if everything else is I would say, looking at all the properties combined. It would be an average, if you will, is another way to look at that. Here are some vacancy rate indicators that have come out. This is a link from CoStar. CoStar is a great resource. I am a member of CoStar. CoStar owns the web portal LoopNet as well, and they are by far the leading indicator of market research for all 4 major asset classes. You remember those: multifamily, industrial, office, and retail. They do quarterly updates on all 4 asset classes, and they track national and regional vacancy and occupancy rates. And so here's just a quick little link to one of theirs, and you can go click on their link and find out how to become a member and actually subscribe to their service. And I would urge you to consider that as you further your commercial real estate career. Vacancy rates for retail, again, I've got a couple of different links, one from Statica.com and CoStar here. I've got some additional information from CoStar on industrial rates as well, and you can kind of see what industrial rates have done over the last 20 years. What they've done since the Great Recession. I've got some information here on office rates as well for you to kind of look at and review. Okay, a lot there. potential gross income, stabilized vacancy rates, getting to EGI. We want to now dive into expenses. And expenses, again, on our Knox Street building, we went through some of those, are going to be taxes, insurance, utilities, and then any property management fees, any other legal fees that you might have. Basically, the spreadsheet that you've got access to. Those would be my main categories for expenses. Capital expenditures, as we've talked about, again, those are funds used to, upgrade main physical assets, roofs, large major items. Those are not a typical expense. Those are below the NOI line. So we want to make sure that we pull those out. Now, if a property is replacing, it's an old 70s apartment building, and they're replacing washers and dryers and dishwashers every other month, and those are capital expenditures, but because the building's so old, that's a common occurrence, and we're seeing that year in and year out, then I would say that those are typical expenses because the age of the property. But if we went in and we repaired and we bought brand new washers and dryers for everyone in 1 year, and we had a huge spike in expenses that 1 year due to that one capital expenditure event, then I would say that we would pull that out. So again, just need to kind of analyze the property and look at that and make sure that you're stabilizing. Getting back to the NOI formula, can't drive this home enough. Potential gross income minus vacancy plus any additional income minus expenses equals our NOI. Want to talk a little bit, we've talked a lot about apartment buildings and the effect of potential gross income, vacancy credit loss, expenses, NOI. Let's talk a little bit about office deals, retail transactions, industrial transactions, and the lease structures that we have. We talked about this in one of the previous lessons, but I want to reiterate it here at this point. You've got different types of lease structures, and your apartment lease structure would more or less be considered a gross lease. The owner, the landlord, is paying most of those expenses, if not all of the expenses. The tenant's not paying taxes and insurance. They're not paying, usually the utilities are paid by the landlord, so on and so on. So a gross lease is where the tenant typically pays one lump sum and then the landlord pays all the additional expenses. Now we've got different other lease structures. We've got single net, double net, triple net. We talked a lot about triple net lease structure, which is where the tenant is being billed back for their pro rata share of taxes, insurance, all of the expenses to the property. And so that is a typical lease structure within retail and office and industrial properties. Not always, but I would say somewhat typical. Depends on your market, depends on what your landlords are doing and how they are treating, what the market is doing as far as within your market. So you just have to look at other leases, find out, are they doing gross leases? Are they doing triple net? Are they doing something in between? Are they paying for taxes and insurance and nothing else, the landlord? Is the tenant just paying for their pro rata share of taxes? Again, so you have this, I would say somewhere in between triple net and a gross lease is going to be your single net, your double net. And those definitions are right here. And you can click on the link to 42 Floors, which is a great resource, which will also further define all of those lease structures for you. Okay, expenses. Income minus expenses equals cap rate. We're going to say this multiple times. We're going to drive this home so you understand how to create value. And so we're going to now take you back to the Knox Street apartment tab, and we're going to talk a little bit about the valuation. Again, I want to drive this home. As we were talking before on the cap rates and the income, let's scroll to the very, very top and just kind of go back through the income here. So again, income, this is the income approach. This is our income pro forma, if you will, on the Knox Street apartment building. Every single unit is listed out here, each unit, how many there are. It's adding up the monthly income and the annual income. So if for some reason we wanted to change a number here and we're renting those 3 bedrooms, the very last row, the 3-bedroom, 2-bath, that's $1,800. Let's just say that those are now renting for $2,000 a month. We add in $2,000, it's now going to change everything else, as you can see, and our potential gross income is increased by a couple $100 a month. So again, just something for you to be aware of, that this spreadsheet is live and you can change and edit this as you go. As we scroll down, we get to our vacancy and our credit loss. If we deem that vacancy and credit loss is 5%, we can change the number to 5%. We'll go from $8,000 to $14,000 in loss coming off of that, and that will impact value. If we scroll all the way down to the value, actually let's change that back to 5%, and let's look at what 2 percentage points does in a vacancy rate to the value. So we have changed nothing else other than and we've kept our income and expenses the same, and our cap rate from going from a 3% to a 5% vacancy rate, our cap rate has dropped from 5.3 to 5.1%. So again, these numbers change your value, and the impact on NOI and value are very directly based on what these are. So everything is automatically calculated. You need to make sure that these numbers are tried, true, and tested, and are reflective of the market that you're in. So, as we look at the value here and the impact on value, we talked before about the cap rates and how those change, those divide into the NOI, which has changed. We were around, that number has dropped a little bit because we just reduced the vacancy rate. So instead of 210,000, we're down to 205,000 and change. And as we divide that 205 into 5%, we get 4.1. As we divide that into 5.5, we get 3.7 million. These numbers change on the fly based on the vacancy rates, the expenses that you put in, and the potential income. If we go all the way back up to the top and we were to change that vacancy back to 3%, and we were to go ahead and let's just increase this unit to $2,200 a month. So if we were to increase rents $400 a month, and we go all the way to the bottom, you're going to see what happens to the valuation. So literally $400 increase on that one unit has increased our cap rate from 5.3 to 5.4%. So every little dollar amount, big, small, and different, makes a huge difference to where the cap rate will be, where it is, and what that buyer or seller can anticipate. So going back to our slides here, we want to talk again about cap rates. And again, it is the ratio of net operating income to the property asset. And Property Metrics has got a little link here. You can click on that and get some additional information on cap rates. I have some additional video resources on mynoi.com that are in your resource tab, where I describe cap rates, I describe 10-year internal rates of return rates and such, and I want to make sure that you fully understand. Cap rates are not interest rates. I want to repeat that. They are not the interest rate. A lot of people will call me and they think it's the interest rate. It is really an indicator. It is an indicator to NOI. NOI is potential gross income minus vacancy minus expenses is your NOI. It is a relationship of NOI, as you can see on the right-hand side down here, NOI to the cap rate to value. NOI divided by the value gets you the cap rate. So again, I want you to make sure you understand that trilogy, if you will, of those three different indicators, those three different numbers, and how they relate to one another. Cap rate is not your cash-on-cash return if you have debt on the property. It is your cash-on-cash return if you pay cash for the property, because there is no debt, there's no leverage. So we've paid cash for Knox Street, we paid $4 million, we put all of that money down, we're enjoying 5.3% return, which is our cash-on-cash return, because that is, we've paid cash for the property. Once you introduce leverage, debt, into the property, which again allows for leverage, allows you to put less down than the property asset, and then depending on where your interest rate is and the terms and the amortization, as we saw in the Knox Street template, you fully understand then what my rate of return would be. And that number was a little less than the cap rate, just over 4%. So again, need to fully understand that. And that's the cash on cash return without principal reduction. When we add in principal reduction, that number increases. Again, the power of leverage. So, I want to talk a little bit about extrapolating out cap rates and some of these numbers from comparables. And so I've included in here some comparables that we did on Knox Street. And so this is a sample grid, and you'll have this Excel template as well in your resource guide. But I just wanted you to look at, these are real live comparables in our market. And this is a property that sold in 2015. It sold for just about 8.8 million. I have the marketing time, I have the number of units, I have the NOI, I have the NOI per unit, and I have the cap rate. And so again, a lot of these cap rates, as you can see from the market, were between 5.75 and 6.6. And so the cap rates that we used for this particular property are all an indicator of the NOI to the purchase price. And so as we extrapolate those out, we get what it is. And this is a good grid for you to then look at and analyze properties. We also look at them on a price per square foot, and you notice that they vary very widely. They range from $106 to almost $240 per square foot. We also analyze them on a per unit basis. And you can see that the price per units range very widely, from less than $100,000 to over $260,000 per unit. You have to dive into the comparables. You have to look at them and say, okay, what is the NOI per unit? And you'll notice on the one on 32nd Street, the NOI per unit was over $17,000, much higher than the $6,000, $13,000 of the other comparables. Why is that? Well, that particular property was 8 units, and they were all 4-bedroom quad units that rented for a very large dollar amount. So they're generating a lot more NOI per unit, and thus it's sold for a much higher on a per unit basis. So you need to compare apples to oranges, and again, when you're comparing apartment buildings in this particular scenario, or with the Knox Street comparable tab. So make sure you do your research, make sure you've looked at the comparables, and that you're analyzing them well. Okay, next slide here, we're going to talk about more about comparables and talking a little bit about the resources that you have. I want you to go ahead and, again, stop this if you haven't already, and pause this session and make sure that you've downloaded the Knox Street template, the 4 benefits of real estate template. Those are the Knox Street that we've been dealing with. Make sure that you edit those, play around with those, save that as a master template, and then put your own properties in your own market into those tabs. We also have another free tool for you, and you're going to be able to go to this link, and it's called My NOI, and it's the Investment Property Valuator. And we're going to take a minute here to show you this tool. And so there's going to be a link here in your resource tab. We're going to take you out live and show you this tool. And effectively, this is the Knox Street spreadsheet in a web tool for you to play around with. So as you come in to the MyNOI, ipv.mynoi.com link here, and we can come down, and this is going to teach you everything about potential gross income, about vacancy, about the impact of value, and it's going to generate the same tabs that you already have in that Knox Street spreadsheet. So let's go ahead and let's go ahead and take a look at this, and let's recreate the Knox Street. So we're going to say that we're buying a property and that we're buying a multifamily property because we're buying Knox Street. And if we go to the next step, it's actually going to take us. So we've got 7 steps at the top, as you can see, and it's actually starting to build a pro forma for us. So it's got some defaults in here. We can provide the unit details or we cannot provide the unit details. If we click the button to provide the unit details, it's actually going to bring up, we can add in every single unit as we did at the top PGI section of our spreadsheet. We're not going to do that today, and we're just going to go ahead and summarize the total dollar amounts here. So as we do that, and we'll go ahead and we're going to go ahead and add that in. So we have put in here the total property income. It's not loading. There we go. There we go. Let's go to the very, very top, and we'll go ahead and take in here we'll grab the potential gross income, which is $291,000. So we'll just take a round number here. We'll get close. We won't take exactly. We'll put in $291,000. So we've gone ahead and added that in. And if we just take 200, let's just take 291,000 even. I think it's just, it doesn't want dollar signs, it just wants an actual number. And as you type that in and hit enter, it will calculate out the monthly amounts for you. So the total square footage, and again, I'm just summarizing this, is 15,670 square feet. I've got it here now, 15,670. And then we're gonna take 3% as our vacancy rate. And you're gonna see it's building our model for us. So it's done that. And it's got this here. We're then gonna go ahead and we can provide the expense details, or we can go ahead and just put a summary in. So for time's sake, we're just gonna go ahead and put in the total expense ratio, which was 24.6%. So we can just put in 24.6%. It's calculating the monthly and the annual expenses for us. And you can see it's building us an NOI spreadsheet over here on the right-hand side. So as we do that, we get to step 4 very, very quickly. We've done an entire investment analysis in minutes here. And then we can put in the property sales price. So if we know what we're buying the property for, $4 million, we can put that in. Or we can go ahead and put in a cap rate. And we can say what the market cap rate is. So depending on what you're doing and how you're analyzing, may deviate what you want to do. So we've put in 4 million, and our numbers are slightly higher because we didn't have the exact dollar amounts here from our spreadsheet, but we're close. We didn't have some additional income and a few things, but we're at 4.9 million. If we slide this bar down to 4.5 cap, you know, you'll see that the value is changing on the fly. So this is showing you in real time the impact of NOI to value. And so I want you to play with this tool. I want you to understand this and be able to deal with it. But we will go ahead and put $4 million in. We will go to the next step, and we will go ahead and then put in our mortgage information. So we're gonna assume that we put 30% down. We can put percentage here or the hard dollar amount here. It's gonna then calculate, obviously, how much we're having in a loan amount. We'll put the interest rate in, which is 4%. We're gonna put the amortization schedule in of 30 years. And then it's gonna calculate our payments for us, just like that. It calculates a debt coverage ratio, which is something that your banker is gonna want. And then we have then built an entire model here. As we go to the next step, this is then going to take us into the 10-year cash flow analysis section. So remember we talked about those growth rates, and we're gonna go ahead and grow our income at, let's grow it at 4%, and we'll grow the expenses at 3%, and we're gonna assume a reversionary cap rate. We'll just put that in at 6% even. And then we're gonna click the button, and it's gonna create for us a PDF downloadable version of our 10-year cash flow analysis and the internal rate of return. So year 1 income, expenses, net income, growing, our cash on cash return, our return before taxes with principal reduction. And again, this is for example purposes, it's close to our analysis. It's not exactly perfect, but it's very, very close. As we scroll all the way down, you're going to see our internal rate of return, and it's roughly 15%, very similar to what we've done before. So another quick way and a tool that you can use to be able to calculate out any property, any investment, and figure out the value. If you want to go back a step and change something and see what the property would do at a 6% cap or a 4 cap, or change the income, you can do that. You can save your sessions. You can email this out to a client, variety of different options. And we have some video tutorials for you on how to use this tool to the maximum ability that it has. And so, free tool for you. Again, we've got a calculator session here that shows you exactly all of the main salient facts on the investment property, and you've got a PDF version of this. As a broker, you're going to get your own branded version of this that you can then use for your clients. You can set this up as a lead capture site. Hey, want to know how to value your property? Come use my free tool. Send it out to clientele. Here's a great way. We use this often, and it's been a phenomenal tool for us to be able to use. It's my spreadsheet over multiple years, put into a web tool, branded for you, that you can then use to interact with your clients. As investors, buyers, and sellers do sessions on it, you will be notified of those sessions. You can help them with those sessions. You can see what they're doing, interact with them. Great tool, all happening in real time, showing them the power of NOI, of value, and what that investment looks like over a 10-year time span. So, great tool for you. I wanted to take some time to be able to show you the IPV on my NOI. We call it the Investment Property Valuator, and that is a free tool for you. Okay, a lot of information. Wow, we have done a lot. We've done years of work in just about an hour. And so I want to take a couple of different moments here to talk about some other ways to generate cap rates. And we talked about the impact of interest rates and cap rates. And there is another video here that you're going to be able to click on, and we'd like you to watch as an option to know how to do a build-up method of a cap rate. And this is how you extrapolate out a cap rate from where market interest rates are. And this is going to require you to do some calculations, and this is something that a lot of commercial appraisers use as a check on market cap rates. So it's called the cap rate build-up method. There's a link here that shows you how to do that, and then there'll be a little video here on how I build up and create my own cap rates. So wanted to talk about that. Another way, when you don't have market data, to create a cap rate that you can then divide into the NOI and get a value. So in a time where you want just a check on cap rates, if you don't have any market data that gives you a cap rate, if the comparables are purchased and there's no income being shown, so you have no idea what the cap rate is because you're not, maybe there's no data to show what NOI is. Maybe they're an owner-user building and they're not showing what they currently pay, or they bought it themselves so they're not a tenant in their own building, so to speak. Just another great way to be able to build up a cap rate and create one based on interest rates. Net present value. We have been dealing with net present value through the internal rate of return calculation and such. And again, the net present value is the difference between the present value of cash flows, of inflows, and the present value of cash flows. And we're basically dealing with net present value when we're doing the internal rate of return to a certain aspect. And so there's another video here that talks about net present value. And in simple terms here, when we look at the cap rate, that rate of return that we need, or what the cap rate, and we look at what we need, there is a net present value calculation that's essentially occurring, if you will. And so this video here that you can click on is going to teach you a little bit more, a deeper dive into net present value. And so I've spent hours and hours analyzing this and doing net present value, and this is the actual formulas that create it. So click on the links, watch the video, and this will provide you with some additional information. Okay, cash flow model. We have talked about the cash flow model. I have shown you the 10-year cash flow statement already, and this is I believe it is a great way to be able to look at an investment over multiple years. The cap rate valuation method looks at a value for income and expenses and NOI for 1 year and 1 year only. So again, it's looking at a snapshot in time, your cap rate approach, valuation approach method, 5.3% on NOx into the $210,000 of net income to get the $4 million value. That's a 1 year snapshot. When we look at a 10-year hold period, which is more typical than not, looking at holding an investment for 10 years, we're looking at multiple years, an internal rate of return, and it's a good way to be able to look at an asset over multiple years or with irregular cash flows. So one thing that we haven't done and really dove into is, what if I have very erratic cash flows? And there are some software models that are out there that you can buy, and we'll list those as resources in the resource section of our course, where you might say, hey, I've got a commercial property, the rents are well below market, I then need to go in and spend a bunch of money in 3 years, and then the rents are going to jump 50% or 30%. And so we want to evaluate the property. We want to bring those cash flows back to the present value, do a net present value calculation, and determine what the value is. And so I have a very easy spreadsheet and a template where I've done this, and I will include this in the resource. It's included in the resource section for you. And it is a net present valuation calculation. And we're not going to dive into it deep. I'll have some additional resources on how to do this if that's something that a problem or an issue that you're facing when you're looking at valuating very irregular cash flows in your investments. But I do believe that looking at a property over 10 years, being able to provide these spreadsheets with the IPV calculator software that we have for your clientele will take your business at a whole different level. Once you fully understand this and you can present this to your clients, these are some phenomenal tools that big investors, Wall Street investors, those institutional syndicates, REITs, they're all looking at internal rates of return. So being able to talk to your clients and explain to this in a simple fashion, like our IPV calculator does, I think will help take your business to a new level. So I want you to be able to calculate those, to look at those, and let's just go back to that tab again on Knox Street, just so we're fully up on the Knox Street. If we go to the 10-year tab again, the 4 tabs at the bottom, the 10-year tab, this is our 10-year cash flow. So we're looking at each year. Year 1 is going to be the rents and the income that we put in from the first tab spreadsheet. Years 2 through 11, if you will, are effectively growing our income at 5% and 4%. And we can change, we've modified those a few for this illustration, but you can put those in at 4%, 3%, whatever it is. Maybe it's 0%. You want to see how the property would impact. And so again, as we look at all 10 years, this assuming that we hold the property for 10 full years, we are valuing the property based on the 11th year income. What we anticipate the next year will be is when we're valuing the property. That's why we have the year 11 value, and that value is then the property is being sold in the 10th year, at the end of the 10th year. So we enjoy all the benefits of real estate, of the property, all of the principal reduction for 10 years. We sell the property, pay some fees to sell that property, and then we essentially are getting an internal rate of return calculation over the 10-year hold. So as we scroll down at the bottom here on where it says IRR, you're actually seeing the cash flows. So negative 1.2 million is our investment into the property. We're then enjoying all of the benefits of cash flow each year. 54,000 increasing at, I think in this scenario was 4% per year, expenses growing at 3% per year. That NOI is growing and growing and growing. And then year 10, you're seeing a big dollar amount. And that is the $3.4 million. And that we've sold the property for $5.5 million in this scenario. We're taking the loan balance at that time, subtracting that from the purchase price. We take out some additional costs for excise tax, closing costs, commissions, and then we get a number that is the dollar amount that we're getting. So this is fully enjoying all 4 benefits. Technically, it's only 3 of the benefits. We haven't calculated depreciation into this scenario, but 3 of the 4 benefits: principal reduction, cash flow, and appreciation into this internal rate of return calculation. And then that comes back, we get a number, which in this scenario is 15.7%. And that, to the best of my knowledge, is a number that is an average return over all 10-year period, over all 10 years, assuming the growth rate of 4%, assuming the expense ratio growth rate of 3%, assuming the NOI that we currently have, and assuming that we sell the property at a 6% cap based on year 11's income. So a lot of assumptions there, but again, that's what we do. We forecast, we look at, we anticipate, and we can run this a variety of ways. If we were to change this cap rate to 7% right now, we're obviously our internal rate of return is going to drop, because now we've only sold the property for $4.7 million. Our loan balance and the proceeds coming in year 10 are now only $2.6 million. If the income only grows at 2% and the expenses grow at 3%, let's go all the way back up to the top, and let's just assume that our income grows at, let's assume the income grows actually at 2% and expenses grow at 3%. What if expenses grow faster than income? What happens? So let's go to the bottom and see, and at a 7% cap, we're actually only making a 7% internal rate of return. So probably not acceptable, but again, you can test this, you can look at it in a variety of ways. If we put that 6% cap back in there, let's see what happens. We get almost a 10%. So our cash flow is growing very slowly because our income is growing at a reduced rate to the expenses. So something to keep in mind to be able to look at and test and play with. So back to our presentation here. Again, internal rate of return is the rate of return an investor can expect, assuming they put money in and enjoy those benefits of real estate, and in this scenario over 10 years. And so, this is looking at it with leverage, with debt. We've put 30% down in this scenario, and we've enjoyed those benefits. I have a couple of videos on IRR. I want you to go and watch these videos, and this will talk a little bit more about how I use the IPV calculator and more details on internal rate of return. Okay. Finally, we've got capital accumulation, and I just wanted to reiterate here that in my own investment portfolio, in the properties that I have, that we look at how much capital we accumulate over time. And individuals and companies can accumulate capital through investments. Capital accumulation also increases with a return from an investment. So you are enjoying the benefits of this investment by increasing the value, increasing the capital that you, and the principal that you reduce is increasing your capital accumulation, and that is how wealth is created. And so it is the number one reason why people buy investment real estate, is to increase their net worth for capital accumulation, and it's something that you can be teaching your potential buyers and sellers, investors, on really how to increase their net worth. You are their commercial real estate financial advisor, and you have the ability to be able to teach them all of these different 4 aspects of investment real estate. Whew. Big session. Investment analysis. Let's go through a summary of what we've learned. We've looked at the importance of NOI. We have talked about the benefits, the 4 benefits of owning an investment real estate. Cash flow, depreciation, principal reduction, appreciation. Make sure that we fully understand those. Look at the 4 benefits tab on Knox Street and make sure that you test that with your own properties. Put in your own information. We've looked at intro to income and expenses and value. We've looked at the impact of how to calculate value, what a cap rate is, the trilogy between NOI, between value, and the cap rate. Understand that. We've looked at the basics of net present value. We've looked at the cash flow model and the internal rate of return rates and how that looks at an investment over a 10-year time span. Buying the asset, putting money down, enjoying the benefits of cash flow, selling the property, and enjoying the benefits of principal reduction at the end. And then we just talked about capital accumulation, which is really why we do this, is to accumulate capital, accumulate net worth through real estate, through investment real estate, and that is what you're teaching. So you can go further with this lesson. There's going to be some breakout sessions. You might need to watch this session 2 or 3 times. There's a lot here. The key is going to be for you to go and edit those case studies, to look at my case studies, to play with your own case studies. Go to the IPV calculator on MyNOI. Run your own scenarios. I'd like you to see you run at least half a dozen, if not 20 or 30 different scenarios. I think you need to, the more you play with this, the more comfortable you'll feel in analyzing properties. Watch some of the breakout sessions, look at our tools, go to mynoi.com, which is free to you, and be able to read and watch some of the articles and the videos that we've got that take a lot of these investment analysis tools further. Okay, big exhale. There's a lot there. 20-some years of my life in little over an hour and a half. You might need to watch this again, but you made it. Congratulations, and make sure that you are watching those extra videos and playing with those templates.